some other parts, the structural parts. They have approached us. So at this moment, we are adjusting that how we have to deal with it. Maybe in the next quarter, we will come out with the what finally we are going to do with them. And now Rajiv is going to explain about the order book.
Yeah. Further to add on Maruti, we see a good opportunity with the hybrid acceptance by the customers. Like you are aware that we are supplying and we are single source for the Toyota two models, 1.5 and 2 liter. So this same platform will go to the Maruti Grand Vitara and Invicto. So there we see a good volume generation, and together they are working on a lot of hybrid models. So we see an incremental volumes for the existing volumes going forward. So that is again a good addition for Alicon. Now talking about the order booking, yes, it is going quite well. In last year also we have achieved sales of around 97-98% of what we have planned. So roughly around 770 crore we have booked with the order bookings what we have planned, and this year we are aiming to do a sale of around 1,200 crores from the new business. The momentum is going good, as I have stated in past also, like whatever additions we have done till date. So around 83% of business is from the four-wheelers and around 56% is from the global customers. And in this total chart, around 22% is also from the non-auto. And even if I split the hybrid, it's more than 8% in a hybrid on the order booking what we have generated. So this means we are touching at all the avenues so that we can take leverage of all the segments going forward. And the order booking, we have now clear booking of around 9,150 crore from 23-24 to next 6 years till 28-29. So there also we are strong on execution and utilizing the orders what we added and convert into sale.
Okay. Thank you so much, sir.
Thank you. We'll take a next question from the line of Yash Dalal from Sushil Financial Services. Please go ahead.
Yes, hi. Firstly, congratulations to the management for reporting your highest ever quarterly revenues for second successive quarter. My first question is, what is the volume growth in Q4? Because revenues have slightly increased this quarter, where EBITDA margins have risen to 14% from 13% last quarter, if we don't account for ESOPs and one-time expenses. So what is the fall in realization this quarter due to raw material price fall?
So raw material prices actually that the improvement in the margins is due to that I explained that two reasons. One is the change in the sales mix, and another is the settlement of the alloy prices, because in the Q4 those were on the lower side. So that is the reason we can see that the improvement in the margins. So major driver is that the sales mix, what we say. And we have started some new part like the JLR prototype we have started. So those supplies were there.
Okay. So also you mentioned that 1,200 crores for FY25 is coming from the new business. So the old will come down to 600 crores. Is this mainly because we've dropped the noise parts?
Ideally, all the products have a life cycle, depending upon how the model is accepted by the industry or by the consumers. But yes, some is end of SOP, some is the customers are working every time with new technologies, upgrading their models. So that also is contributing. And second is yes, with a direction where we shifted our focus and leverage to passenger and commercial.
Okay, thank you. Just a couple of more questions. So also there is an 8 crore written off. What exactly is that, and is it one time?
So these are the some receivables, old receivables. So maybe we already provided earlier, so but only written off in this part. And these, because we are running a big business of maybe now we are talking about 1,800 crore sales. So it is not going to happen that only there will be zero write-offs or anything. Maybe some small amount will come continue, but it is a business, so I cannot commit, okay, it will be zero, but I cannot say that it will be 8 crore, maybe it can be 2 crore, 3 crore. So it is a part of the business.
Okay, thank you. And just the last question, what about your technology of friction stir welding? By when should we start seeing the benefits of this new technology?
This will happen in the Q3 of this year. So ideally, yes, we were little aggressive. Even our customers were aggressive with this model, but some changes in the model they have executed. So with that, we are expecting this to differ by a quarter. But yes, we will start supplying some samples in Q3 and thereafter ramp up in the next year.
Okay, thank you so much.
Thank you. We'll take our next question from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Hi, thank you for the opportunity and congratulations on great numbers. My first question is on the subsidiary business. We've seen a significant improvement. If you can talk about how the business has been in subsidiary business, and how do you see that moving forward as we have a healthy growth rate? If you can share some outlook on the subsidiary business. That's my first question.
So for the subsidiary business, that maybe in this year we have seen a good growth, and maybe in the current year also 23 or 24, 25 definitely we will have a good numbers. But there are two reasons for this growth. One is that for their existing business, so that is growing because especially like battery housing for the Samsung that goes to JLR, or some volumes from the two-wheeler like KTM and BMW. So all these volumes have gone up. On the other side, that the development of our JLR product is also happening in Europe, so in Alicon. So that sales has also booked in 23-24, and maybe because some this year also we have supplies of the prototype casting to the JLR customer. So in this year also we will see this the good numbers for our company Alicon in Europe. But the coming years, so we should not expect the big growth because we just want to use that place for our as a development center, as a engineering center. So because like for this product we have hired the technical people from the Germany, designers, tooling, all these things. So we are more focused how to use the technology from the European suppliers. Those engineering is available from Germany or some other countries. So that is the base. So when we talk about the numbers, to convert in the numbers, so I don't think there will be a big jump in the coming years in Europe. So that because this definitely this business will shift to India, and the mass production will happen in Alicon India.
Yeah. So basically the intention is if any new technology is in the market, they hit first Europe, USA, China, and we see a lag after 2-3 years it comes to India. So the idea is to be early in that market. So we use Alicon model that way. And that also supports to our customer when we are very close when I talk about global regions. So and second is we see there are a lot of development experts, good technologies across Europe. So it's easy for us to get those know-how. So a lot of learning we have added with this development, and yes, we have noticed we have got a benefit of sales in Q3 and even in Q4, and some will definitely add in Q1. But going forward, our intention is any large volume or mass production better keep in India so that even customers get the benefit of the cost.
Right, thank you. My next question is on the machining capability. How much are we outsourcing as of today, and whether incremental volumes would require more outsourcing, and whether that impacts the margin overall? If you can comment something on the machining capacity, outsourcing, etc. Thanks.
For the machining, approximately 60% is in-house and 40% we have outsourced. And now we are building more in-house the capacities, like because some customers those are coming with the new parts, so they look for the in-house machining. So generally, due to the their quality requirements and the control on the product, so in-house capacity building will be more in the coming years. So that's the reason, one of the reason for increasing our capex in this year.
Right. So we are expecting this mix to remain at 60/40, or because we see a very high growth?
I think in-house will increase. But we will try to, because whatever we are doing in-house, if something we can outsource, because we need the content from the customers also.
Right. Great. These are my questions. Thank you.
To de-risk the capacities, otherwise maybe some volumes are down, so our all in-house capacities utilization will go down.
Right. Thank you. That's it from my end.
Thank you. We'll take our next question from the line of Chirag from White Pine. Please go ahead.
Yeah, thanks for your opportunity. So just one question. Your gross margins even sequentially has seen a significant jump and the single largest region of EBITDA margin expansion. So if you can just elaborate a bit more on this, it would be helpful. Because suddenly what happened in Q4 that the value added happened. So, and is it a normalized gross margin for this should be the base for F25, or how should we look at it?
Generally, gross margins are driven by many variables. First is that the sales mix, how it is moving, that which parts, then the processes on this product like machine parts or raw castings. Second is important factor is the aluminum prices also. Like if what we are seeing that upward trend in the aluminum prices, maybe in the last 2-3 months we have seen a 8 to 10% increase in the prices. So then it will definitely will increase the material cost percentage to sales. And on the other side, if we see that there is an increase in the volume of the raw casting, especially the two-wheelers, because we are seeing a good jump in this year of 24-25 in the two-wheeler also. So that is also going to drive this our gross margins. So, but what you are saying that in this year it is a good where we have seen the very this improvement in the gross margins, but maybe I think that will establish between 48 to 50%, means the margins between 52 to 50% in that range. That will move.
Okay. You're saying on annualized basis it should be in the range of 50 to 52%.
Yes.
Okay. But sir, what happened in Q4 specifically? Because YOY I understand, even Q on Q there is a sharp jump in gross margin.
As I explained that the sales mix, so some big volumes we have supplied where our gross margins are higher, that we have supplied to the customers. And another is that I'm saying that in this quarter the aluminum prices were at the lowest.
Okay. Or is this the impact of any year-end negotiation or conclusion with respect to your pass-throughs from OEMs? Because generally we have seen your Q4 margins tend to be significantly better, gross margins. So is there any, like, whatever hike you are expecting from your OEMs get settled in Q4, and hence this is a general phenomena?
No, very small impact, because it is there but not so big, because generally, for the aluminium, what we have seen that 60% aluminum buy is already settled by the customers. So they finalize the price with the suppliers, they allocate the suppliers, so and the settlements are on month-on-month basis. And for other customers also, they do on quarter-on-quarter basis. So this happens, what you are saying, that when the settlements are on yearly basis, or they delayed the quarterly basis, maybe it is set on quarterly basis, but they are not doing, they are delayed for 2 or 3 quarters. So in that case this happens, but generally I have not seen such kind of impact.
Okay. So one last question, you indicated that you are putting it a huge 150 crore capex this time, to add new machining capacities for different type of products.
Yeah.
In the order book that you have today and future order book that you are anticipating, would you be needing any similar huge CapExes, given that different type of products would come in and, or this is now for next 2-3 years, it will be again normalized CapEx?
So this year is the biggest capex we are going to have because we have to build up the infrastructure. You know that when we are going for the high volume for this JLRE and PSA. So one is that only increasing the machines, the capacities, and another is the complete installation of the infrastructure, the technology. So in this year we are doing this like when EXL or for PSA infrastructure installation is there, but after that when volume will grow, so we have to just add the machine this casting capacities or maybe just increase our, because in this like take example, for a year they talk about 100,000 pieces. So I cannot put up the capacity for each process of 100,000. Maybe one capacity I have to put maybe 200,000 because it's not possible to do that. So later on when we increase the capacity from 100,000 to 150 or 200,000, so I have not to put the complete infrastructure. So only just balancing, I have to balance the capacities for each process.
Okay, thank you. Thank you very much and all the best.
Right. Thank you.
Thank you. We'll take our next question from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Hi. Thank you for the opportunity. I had 3 questions. So my first question is, we are seeing a lot of traction in the global markets, and we're growing at a pace at much faster than the end industry. So wanted a sense of which are the large competitors that we have, or who are the biggest competitors in the aluminum casting business, which countries really dominate this industry, and if you can talk about some of the +1 tailwinds that we're seeing, whether it's from China or from Europe or more outsourcing. Just want to understand what is driving this strong traction that we're seeing.
Okay, talking about the global competition, there are competitors, but those are segment-wise. There are specific firms who are into four-wheeler cylinder manufacturing, like Jay Hind is there, then Nemac is there, then Montupo is there. So many more are there in that segment. But with Alicon, what is one of the USP with Alicon is we have a variety of parts, and that differentiates us with other competition where, today OEM are working into multiple technologies, be it IC, be it hybrid, or be it EV, or look for a structural part. So they are also aiming to reduce the supplier base, because that's a cost. Adding a supplier is a cost for them. So that's the reason of a long term they are looking for partners who can give solutions into various verticals. And also they see the strength of that supplier, how much is the capacity, how much is their experience in this industry, how early they are with technologies, and how much is their presence globally. So these are again the plus factors which support us. Yes, we also noticed some customers are shifting from China and they are opting to India. Even recently we're noticing customers are shifting from Thailand to India. So that also is a new thing which we are noticing. So we are ready for that, and for customers also to approach is very easy because we have seen a customer base, large of customers we have already delivered few parts in past. For them also to add or to interact is very easy. So we are ready for that, and we are looking to materialize those opportunities which we are getting recently.
So in this mainly that Alicon is the largest foundry in India as an independent foundry, because all other major foundries, those are in the umbrella of the OEMs. And also the observation like Rajiv has shared that we are seeing recently that the sourcing of casting, aluminum casting is shifting from China, from Europe, from US and to India. And the first choice what we are seeing that the Alicon first. Because maybe, and we are the not so big company as per the requirement globally. So that is a big opportunity what we are seeing opening up for Alicon in the coming future. as well as when we are talking about what you have asked about the competition. So in India, as a independent foundry, we are the largest one. So competition is less because all others are an umbrella of OEMs and they are supplying to their parent companies. And at the global level, our share is very less. So there is no meaning at this moment saying the competition. Then when we become a large company and then the big supplier at global level, then the question of competition comes. So whatever we are getting the businesses and the OEMs, they are shifting the sourcing. So these are the big opportunities what we are seeing here.
Got it. And just a follow-up question on this. Right now globally, there's there's cost pressures that were there. Everyone would want to work with a good quality but also low-cost players. So when we benchmark ourselves to say a Chinese player or a player from the Europe, US, what is the cost difference for us versus them?
There is a cost difference. One is the little we see on the aluminium, as they are the largest producers of aluminium. And second is, yes, they are also offering to large scale. But with Alicon, one is this is an industry since long, and we work with customers since inception of the design. So during the design, we see if we can reduce the weight of the part, so that we can pass on some benefit to our customers. That is one where we play. And also, as we are into multiple processes, like we are into gravity and low pressure. So we evaluate during design stage which process will give a better results in terms of productivity or better results in terms of yield. With that, we submit a proposal and customer is accepting. And third is our partner, Enkai Corporation, who is also having plants across 19 countries. And they are also in this industry since long with the same process. So continuously we get upgraded with the support. Even our team members frequently go to their location, they come down to our location, and continuously we are upgrading our operations so that we support to our customer. So with that, even customers are now preferring us over Chinese. It's the combination, and more is about the volume game, what we can support to our customers.
This is one part that one is that China, maybe we can't say that we are very much competitive against China, but there's some political reasons they are shifting to India. On the other side, when we talk about the Europe and the US, so this is not only the cost side, the only cost benefits they are having and shifting to India. That is one of the factors of the cost, but they are also seeing the challenges of the supplies from their local suppliers, like the quality, the volumes, because the existing suppliers, they are not ready to increase their capacities, maybe to the financial, whatever the challenges they are having. So these are the main factors for shifting, that Alicon is able to supply the volumes, we are able to supply the quality, and then we are able to maintain the required stock and maintain the just-in-time supplies to all their requirements. So these are the major benefits they are having when they look for the supplies from India as well as from the Alicon.
Got it. And just one final question is, we want to over time increase our return on capital employed to 20%. You've already explained your EBITDA margin trajectory. I just want to understand the balance sheet size, the balance sheet metrics a little better. How do you see the asset turns, at what asset turns and at what net working capital days do we kind of hit this 20% mark?
So mainly that asset turn definitely now, because one is the existing capacities, because immediately for the existing, so we cannot change. Maybe some improvements in the productivity that can happen, but for the new products like we are explaining, where we have the high value, means the high weight of the casting, higher value additions. So that is giving a good asset turnover ratio in the coming business, whatever we are adding. So this asset turnover gives slow growth. It cannot jump from maybe I'm at 1.8 or 2, so suddenly next year I will see a 3. This is not going to happen, but slowly it will improve year on year basis. we'll see that growth. Because when we are talking about the ROC, so ROC major driver is that how we are controlling. One is that definitely from this side because controlling the investment. Second is more focus on this part of the margins and the working capital. Maybe you must have seen that year on year we are reducing our number of days working capital, and hopefully in this year also you will see the further improvement. So we are more focused how to reduce our inventories, and now because we are seeing the growth in the exports, so how to reduce our debtor days, receivable days. So definitely in this year we'll see a further improvement in the working capital cycle.
Is there any number that we have in mind in terms of target ratio that we want to target on the working capital?
So maybe 8 to 10 days, because I think we are near to about 78 days in the net. I'm not having the data correctly, but I'm just the idea that based on you are just reviewing this. So maybe I think 7 to 8 days, so at least we are targeting further reduction in this year.
Got it. Great. No, thank you so much for answering my questions. I appreciate it.
Thank you. We'll take our next question from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, sir. Thank you for the opportunity. My question is with respect to this PV clients, which is Maruti, Kia, Toyota, Stellantis. What kind of incremental business is expected based on the schedules that you have for FY25 and FY26? And what was it in FY24? Just for me to understand and corroborate with the 15% top line growth number that you have shared.
So yes, for this financial as 24-25, we see an opportunity to grow with this passenger vehicle segment. So around customer like PSA will give us 50 crore.
You can give combined, it's okay. I don't want customer-wise. I want a combined number if you have that. That's also okay.
So roughly around 180 to 200 crores we will get with Maruti, PSA, Toyota, and also global customers. The past what we added recently like Mahle and Taco.
Okay. This is incremental?
Yeah, this is incremental. And
in FY26?
FY26 further to this, Jaguar will be added. Like this year also Jaguar, the e-axle what we developed and another part, a battery tray again for the Range Rover EV. That will go into sample submission and few more validation. But major ramp up will come in next year, and that would be adding around 150 crore addition with this. And further we are expecting another cylinder head from Maruti to add in and go in ramp up in next financial, followed by some additions with existing customers like Danfoss.
So you are saying 180 crores in FY25 incremental, and then another incremental of 150 crores in FY26. That's how it is, right?
So in 25-26 further to this will be a domestic customer PSA, which will go into ramp up at the peak.
So actually I tell you that when you are going to make a comparison with the 23-24, so approximately the incremental at this moment, because from the big numbers we know, because some existing customers will also grow. So 200 crores we are seeing that incremental from there, and approximately 500 to 550 crores in the 25-26. From take a base of 23-24.
So what is 23-24 number for PV? In the 1500 crore top line, how much is PV?
PV would be around 44%. Sorry. Yeah, it's 44%.
44%. So to this number, incremental 500 will get added. Now I don't understand, sir, what you want to highlight actually.
Actually, we have also not understood
You are already,
properly.
sir, you mentioned about a lot of increment of lot of these programs from different customers. So I wanted to know incrementally or let's say point to point. Now, if 44% of your business today is